Have you ever, scrolled through those pictures of super chic, members-only clubs? You see the beautiful interiors, the exclusive events, that kind of global network feel that just, it promises connection, success. It's that definite allure of a brand like Soho House & Co., a real magnetic cool factor.
Hmm.
But what if, behind that shiny surface, there was this deep financial vulnerability? What happens when the velvet ropes don't lead to endless possibility, but maybe to a really critical financial crossroads?
It really is the ultimate luxury paradox, isn't it? With Soho House & Co., or SHCO, we're looking at a company that's done this masterful job cultivating an incredibly powerful global brand. And they've built a really loyal, growing membership base. I mean, on the surface, they've driven some truly impressive top-line revenue growth.
Right.
Yet, beneath that sort of glittering exterior, this outward success has consistently masked deep net losses, a really crushing debt burden, and maybe most critically, negative shareholder equity. That's the core dilemma we need to untangle here.
And that's exactly what we're diving into today. This isn't just, another story about a fancy brand. It's about a fundamental shift in its investment landscape. There's now a definitive agreement for SHCO to be taken private at $9 per share in cash. So our mission for this deep dive, it's really to transform what might look like a straightforward, maybe long-term growth story into this fascinating, event-driven, special situation opportunity. We're going to explore, is this $9 offer basically a lifeline for a company that's struggling? Or is it actually a pretty savvy move for the public shareholders? Let's dig in. So, okay, let's start with that incredible appeal. Because when you think Soho House, you instantly think exclusivity, creativity, a certain global cachet. Their business model, it's quite unique, isn't it?
It really is. It's a curated membership platform. You've got around 36 exclusive Soho houses globally, plus these Soho Works co-working spaces, the famous Scorpios beach clubs, and even the net hotels.
And the revenue streams really show the model, right?
Exactly. You have two main ones. First, stable recurring membership revenues, like a U.S. every house membership runs about $4,800 a year. Pretty significant. And then you have the variable in-house revenues. That's from all the dining, the rooms, the spa services, everything else people spend money on inside the houses.
Yeah.
And what's truly impressive, I think, is how effectively they've scaled that whole concept. They've pretty much cornered a unique market position. They've established themselves as, well, the only company to have really scaled a private membership network with a truly global presence.
Wow, the only one globally.
As far as this specific model goes, yes. This puts them right at the forefront of an industry, the private social club market, that's projected to grow quite significantly.
Yeah.
Potentially hitting, what, $25.8 billion by 2027?
Right. So you see the brand, the growing members, the luxury feel, and you just naturally think this has to be a gold mine.
Yeah.
But then the numbers. The cold, hard numbers, they tell a very different story, a much starker one.
Exactly. That's the aha moment, isn't it? While the brand is undeniably strong and growing, I mean, they hit over $1.2 billion in trailing 12 months revenue, which is huge. The financial reality is, well, quite grim. Despite that strong top-line growth, SHCO has consistently failed to actually translate it into net income.
Consistently.
Every single fiscal year as a public company, they've reported losses. We're talking a net income of negative $113 million in the trailing 12 months alone. It's just a remarkable disconnect.
So more money is coming in the door, but they're still bleeding cash. How does that even work for a brand with such obvious demand?
Well, that's the critical insight. And to drive home a really crucial point, the company has negative shareholder equity. It stood at a deficit of $349 million as of Q2 2025. Now, this isn't just some, abstract accounting footnote. This signals technical insolvency. It means their liabilities actually exceed their assets. And that severely constrains their ability to raise fresh capital. Imagine trying to get a loan or issue new stock with books like that. Banks would hesitate, and new equity would massively dilute existing shareholders.
So it really ties their hands financially?
Absolutely. This financial predicament is a direct result of their incredibly capital-intensive business model and very high fixed costs. Just think about the constant, ongoing expense of acquiring, renovating, and maintaining dozens of luxury properties all over the world. That's a massive fixed expense base. It needs constant, high-volume revenue just to cover it. This reality likely made the take-private deal not just attractive, but a sort of strategic necessity, a way to escape the constant pressure and scrutiny of the public markets.
Okay, that makes sense. The costs are just relentless.
Precisely. You see a healthy gross margin, around 62.7%, which means they're actually pretty good at making money on the services and memberships themselves. But then you look at the deeply negative net profit margin, negative 4.7%, and their negative return on equity. Well, that tells you they weren't generating profit from shareholder investments. The problem isn't bringing money in, it's managing the enormous ongoing costs of building and maintaining this global empire.
Which brings us back to that ultimate question, right? How does a company that seemingly has it all, this aspirational brand, growing revenue, devoted members, end up, well, kind of on the brink, needing to be taken private? And this is exactly where that $9 offer comes in, a definitive take-private agreement at $9 per share, which importantly represents a huge premium, 83% over the share price before the deal is announced.
Yes, and if we connect this to the bigger picture, it totally transforms the investment thesis for SHCO.
Yeah.
This is where we shift into talking about merger arbitrage. For investors now, the play isn't really about the long-term operational prospects anymore. It's not about whether Soho House can eventually figure out how to be profitable consistently.
Okay.
It's transformed into a pure merger arbitrage opportunity.
Mm.
The central question becomes, does the potential return, that gap between the current share price and the $9 acquisition price, does it adequately compensate you for the risk that the deal might fall through?
So it becomes much more binary.
Exactly. It's incredibly binary for current shareholders.
Yeah.
Either the deal closes at $9, you get your cash, or it collapses, and the stock price likely plummets back down towards where it was before the deal news, which was much, much lower.
So it completely shifts the whole game, from long-term growth story to almost like a bet on the deal closing. That's quite a turnaround. But is $9 really a fair offer?
Yeah.
Especially given the brand's long-term potential, maybe?
That's a fair question. And if you look at the valuation analysis, it really underscores why this offer is seen as, well, fair, if not arguably generous, given their financial state. Things like a discounted cash flow or DCF model, even if you make optimistic assumptions, they struggle to justify $9 a share. One third-party DCF I saw estimated the intrinsic value more around $7.34, significantly lower. And their valuation multiples, like EV/EBITDA, were already sky high, think 25x to 31x, even before any news of this offer came out. So if you put all that together, the $9 offer starts to look like a pretty practical solution, almost like a financial lifeline, actually. It lets shareholders bypass some significant risks and avoid what would likely be a very long, uncertain, and probably painful turnaround period.
And that probably explains why we aren't seeing huge institutional pushback.
I think that's right. It helps explain why, even though you see some shareholder lawsuits, which are frankly quite common in these M&A situations, widespread institutional opposition seems unlikely. The general feeling among many seems to be that this is probably the best available path forward for shareholders right now.
Okay, so if you're an investor and you're looking at this as a BUY recommendation specifically for this arbitrage play, what are the risks you're actually taking on? And I guess how likely is it this deal really goes through?
Right. This raises the key question for anyone considering this arbitrage strategy. The most immediate, the most significant risk is simply deal failure. Now, this could happen for various reasons. Maybe a failure to secure the final financing pieces, though that seems less probable given who the buyer is. Regulatory hurdles could top up, or maybe unexpected complications from shareholder litigation, although, again, that seems more procedural than a fundamental threat here. But the consequence is clear. If the deal terminates, the stock price would likely collapse, heading back towards that substantially lower pre-deal level. That's your major downside risk.
And beyond the deal mechanics themselves, are there still underlying business risks investors should be aware of, even if the deal seems likely?
Oh, absolutely. The underlying business itself is highly cyclical. Remember, it's a luxury product. It's very sensitive to discretionary spending. And that sensitivity gets amplified because of those high fixed costs we talked about.
Right, the expensive properties.
Exactly. So macroeconomic risks are still relevant. Things like a global recession or even just a sustained high interest rate environment that would definitely impact their ability to service their debt and affect overall financial health. It's also, I think, worth noting that the company's reported 5-year beta is 0.66. That seems unusually low.
Beta, that measures volatility, right?
Yeah.
Compared to the market.
Correct. It measures how much the stock price tends to move relative to the overall market. For a high-leverage consumer discretionary business like Soho House, its fundamental sensitivity to economic cycles is almost certainly higher than that historical 0.66 beta implies. So, don't be perhaps misled by that low beta number. The underlying business is far more exposed to economic shifts than that might suggest on the surface.
Okay, good point. And we definitely have to touch on the governance side. Ron Burkle, the controlling shareholder, he's a major player here, isn't he? And he's actually part of the group buying the company. Doesn't that create a pretty clear conflict of interest?
You've absolutely hit on a crucial point there. There are definite governance concerns to be aware of. First, you have the dual-class share structure, which concentrates voting control with Ron Burkle and his firm, Ukaipa. And yes, Burkle's direct participation in the buyout group absolutely creates a clear conflict of interest. No question.
So how is that managed?
Well, the process involves oversight by a special committee. This committee is made up of independent directors, and their job is specifically to represent and protect the interests of the minority shareholders in a situation like this. Now, no process is perfect, obviously, but having this committee involved does help mitigate some of that conflict of interest concern. So ultimately, despite these risks, both the market risks and these governance questions, given that there's a definitive agreement in place, given the commitment to the controlling shareholder, and frankly, the strategic imperative driving this deal, our analysis suggests it actually has a high probability of completion. The financial logic, the strategic necessity, the stars seem aligned for this specific outcome.
Okay, so what does all this really mean for you, the listener, the potential investor here? Let's bring it all together, a cool brand, the shaky financials, the take-private deal, and what it implies for someone thinking about investing right now.
Yeah, let's boil it down. The conclusion is pretty clear. Soho House & Co. has built an undeniably powerful, aspirational brand with a truly unique global footprint. That's the plus side. However, its business model is just intensely capital intensive. It has consistently failed to deliver sustainable profitability, and that's led to a very weak balance sheet, one that's just ill-suited for the constant glare and pressure of the public markets.
So the public market just isn't the right place for it anymore.
Arguably, yes. Therefore, this pending take-private transaction looks like a logical and maybe even necessary strategic step. It offers what appears to be a clear and attractive exit for public shareholders, especially at that significant premium to its pre-deal price.
So this isn't about hoping the company suddenly turns itself around or waiting years for some potential long-term fix. This is a much more immediate, direct play.
Precisely. So the recommendation here is BY. But, and this is crucial, this is specifically for investors who have a tolerance for event-driven risk. This is a pure merger arbitrage opportunity. Your strategy here is straightforward. Right. Buy the stock as long as the spread, the difference between the current market price and that $9 offer price, provides what you consider a compelling risk-adjusted annualized return.
Got it. So not a bet on the clubs themselves long-term.
No. This investment isn't about the long-term fundamentals of a company or hoping for some miraculous operational turnaround. It's purely about the successful closure of this transaction. It's a very specific tactical bet on the mechanics of the deal going through as planned, not really on the future success of the Soho houses themselves.
Okay. As we wrap up this deep dive on Soho House & Co., it really makes you think, doesn't it? How often do these really strong, prestigious brands fullness.
Yeah.
How often do they hide these underlying financial weaknesses? Weaknesses that only really come to light under the harsh microscope of public scrutiny. And what does it say about the market today when maybe the best option, the most attractive path for shareholders is actually a financial lifeline through a take-private deal like this? It kind of makes you wonder what other companies might be out there in a similar boat. You know, incredibly successful brands, but maybe struggling financially behind the scenes, companies that could perhaps benefit from a similar strategic shift away from the public eye. It's a fascinating thought to mull over.
Indeed it is. It's almost a testament to the brutal honesty of financial statements, isn't it? No matter how shiny the brand appears on the outside.
Absolutely. Well, if you found this deep dive into the interesting world of event-driven investing and the whole Soho House story insightful, remember to subscribe to the deep dive. That way you'll get the fastest and most frequent updates on our latest explorations into the complex issues that matter to you. We'll be back soon with another deep dive.